Hi, this is Jack Crooks from Money and Markets TV. Over the past week, we've seen some dramatic moves in the currency and commodity markets. Gold, copper, and the Australian dollar are all getting crushed. That selling pressure is a clear indication that investors are running scared. But the recent movement in another currency may be a much better indicator of what's to come. Take a look at the Brazilian real over the past 5 years. A couple weeks ago, I noticed that it was starting to dive against the US dollar. And if you compare that line to the S&P 500, you'll see that the price action is looking awfully similar to 2008. During that financial crisis, the S&P topped first, but the Brazilian currency soon caught up, and then they both tumbled together. That tells me we could be seeing the same kind of flight to liquidity that hammered so many assets the last time around. The similarities are even clearer if you look at withdrawals from equity funds. According to Bloomberg, in the 5 weeks that followed the Lehman Brothers collapse in 2008, investors withdrew $72.8 billion. Over the past 5 months, investors have withdrawn $75 billion from equity funds. Now the bulls will argue that this is the time to buy. They say that all this selling signals a market bottom, and pretty soon all the money in the sidelines will come rushing back in. But I'm afraid it's not that easy. For the sake of argument, let's say that investors do regain their appetite for risk. That's still only half the story, because this outflow from equity funds is not just about risk aversion. It's also about the Federal Reserve. Over the past couple of years, the Fed's easy money policies have driven capital towards the financial markets. But after last week's policy meeting, the central bank said nothing about a third round of quantitative easing. The Fed just committed to a $400 billion debt swap to lower long-term interest rates. But the problem is, low interest rates are not an incentive to invest. We can see this by looking at the personal savings rate. In 2009 and 2010, it dipped back as investors started to think the economy might be improving. But now, it's rising again as people hold on to their cash. So what comes next? A few weeks ago, I predicted a dollar breakout, which would signify the beginning of a major trend change. And that's exactly what we're seeing now. The dollar broke sharply higher after being range-bound for 19 weeks. What's even more interesting is that in 2008, the credit crunch caused the dollar to break out of a 20-week range in a very similar fashion. To me, this market action indicates a real and substantial move into the dollar. It might be a flight to quality and/or liquidity, and it could eventually turn into something much more. I'm Jack Crooks for Money and Markets TV. Thanks for watching.